Today we're going to talk about how you can build your own $200,000 a year passive income stream. I'm going to go over your options for investments that can generate passive income. We're going to talk about the risks associated with those investments, and I'm going to give you some questions that you want to ask yourself before you start to build your own portfolio that generates $200,000 a year of passive income. Here is a list of investments that all generate passive income. I've built this table to show us what would it cost for each of the respective categories to generate $200,000 a year of dividend cash flow. Now, I expect that most people are going to employ a portfolio strategy, so they'll use a few of these categories, but I thought it would be interesting just to see what the price is for the different cash flows. In other words, how much money do we need in the S&P 500 or rental properties or treasuries or MLPs or covered call funds, etc., to generate $200,000 a year of passive income? What sticks out to me right away is that we pay a huge premium for inflation protection. For example, the S&P 500, which provides excellent inflation protection, only yields 1.15%, and we would need $17.3 million to achieve a $200,000 a year passive income stream, i.e. dividend cash flow. But if we buy 30-year treasuries, we will get 4.3%. We don't have any inflation protection. We only need 4.6 million. And if we go all the way down to the bottom of this table, you can see that covered call funds, which pay 11.5% and have very poor inflation protection, if any, we only need $1.7 million of capital to achieve a $200,000 a year passive income stream from a covered call fund. But there are some caveats to that covered call fund, which we're going to get into later on in this presentation. Before you start investing your money to build your $200,000 a year passive income stream, there are some basic questions that you need to ask yourself. We're going to talk about those questions. Then we're going to dig a little bit deeper into these investment categories, talk about the risks associated with them, and look at some illustrations for some of these categories. Questions that you need to ask yourself before investing your money to build your income stream are: how much inflation protection do you need? How comfortable are you with volatility? Will you ever need any of the principal? And if so, roughly how much and when? And finally, how long do you need this passive income stream? What is your time horizon? Core inflation has averaged 2.38% for the last 25 years. We're going back to the year 2000. Now, that might not seem like a lot, but 2.38% per year average for 25 years has caused core prices to basically double. So $200,000 a year of purchasing power in the year 2000 is now equivalent to about $400,000 a year. So you got to ask yourself, how important is it for you to have inflation protection on your passive income stream? Our investment category table tells us that stocks and real estate give us great inflation protection, but they're very expensive, compared to treasuries that give us no inflation protection but are cheaper. So what does that look like? Let me show you. This chart shows us the long-term difference between stocks and bonds when it comes to inflation protection of your principal. We're looking at the last 22 years for the iShares TLT ETF. That's the purple line. You can see that there is no inflation protection here on principal, sideways for 22 years. TLT is the long-term treasury. The orange line is the S&P 500. Look what happened to your principal over the last 22 years. It went up dramatically. So with the stock market, if you can handle the volatility over a long period of time, you are likely to get significant inflation protection. You won't get that with the bond market. Dividends are the same story. Orange line is the S&P 500, 22 years. You see a nice increase over time in your passive income stream, the dividend cash flow off the S&P 500. It's compounded over the long term at 5%. It's powerful stuff. The TLT ETF, long-term treasuries, no increase at all. Just totally flatline for the last 22 years. No inflation protection. The inflation protection of the stock market and publicly traded REITs comes with a lot of volatility. That's the big risk. But if you buy treasuries and hold them indefinitely until they mature, you're not going to have a lot of volatility, but you are going to have inflation eating up the value of your principal and your passive income stream over time. Now let's talk about principal risk with covered call funds. I said I'd come back to that. I think this is an interesting one. The yield is so high. Many people are interested in this. There's lots of videos out there on YouTube about it. So I thought it would be something that we would want to pay attention to because it has unique and interesting risks that I think a lot of people are just not aware of. Here's a look at a popular covered call fund. We're looking at the Global X NASDAQ 100 covered call ETF QYLD. This fund has an 11.5% yield. So I'm showing you what would have happened if you put $1.7 million into this fund a decade ago. Today, you would have $1.24 million. $1.7 million in QYLD today will get you a $200,000 a year cash flow. But there's a catch. And the catch is that this fund and many others like it distribute principal back to you. So even though the dividend yield is 11.5%, a portion of that dividend is a return of capital. And that is why you see the value, the price of this ETF going down and down and down over the last decade, during a time that the NASDAQ has been on fire going up and up and up. So I think that a lot of people just don't realize that these great yields that they see on these covered call ETFs are not truly income. Only a portion of the yield is income, and another portion of it is a return of capital. So you want to be very careful with these investments. You're not getting any inflation protection on your principal. Let's see what the dividend did. Here's your dividend for the Global X NASDAQ 100 covered call fund. Stagnant for over a decade. No inflation protection. If you need principal out of your portfolio, be sure that you match the time horizon for when you need that money to the time horizon of your investments in the portfolio. For example, if you need $400,000 in 2 years, it would not be prudent to put that money in the S&P 500. But if you needed $400,000 in 10 or 15 years, then you could put it in the S&P 500. So make sure that your time horizon matches your liquidity needs when it comes to the investments that you select. Now let's talk about real estate, MLPs, and leveraged loans. When it comes to real estate, you have a number of options. You can purchase publicly traded REITs or the REIT indexes. You can buy rental properties and manage them yourself, or you can invest in private real estate deals. They have different risks and offer different opportunities. Publicly traded REITs, whether you buy ETFs or individual companies, are going to be your easiest way to get access to real estate. Publicly traded REITs have a better yield than the S&P 500. They give very good inflation protection, but they do come with a lot of volatility. The next way to get access to real estate would be to buy rental properties. In late 2024, the issue here is that the yields are low and the prices are very high. You do get good inflation protection, and you have some risks there, such as not having a tenant, an unoccupied property, or getting a bad tenant. The last way that you can get access to real estate is going to be to invest in private real estate deals. You can get a much higher yield here. Your inflation protection is going to be average, in my opinion, and there are some risks that come with these properties. The general partner, for instance, you have to trust them. Also, if you're in a deal that is just one building, you can have property-specific risks. And finally, leverage risk can also be an issue. If your GP is employing a lot of leverage, then if they get upside down on that leverage, you can be wiped out. So there's definitely risks to consider when you're investing in private real estate deals. Leveraged loans, also known as bank loans, is an attractive asset class that pays an excellent yield. You won't get any inflation protection on your principal, but you will get some inflation protection on your passive income stream. Leveraged loans pay quarterly interest. The interest rate resets quarterly, and that reset rate is based upon SOFR, the standard overnight financing rate, plus a static spread. So if we get inflation and interest rates, short-term interest rates move up, your cash payment will move up as well. Now, leveraged loans have credit risk. If we get a recession, the value of the loans will contract, the prices will go down. But for investors who can commit to owning this asset class for the long term, I think that leveraged loans provide excellent cash flow potential. MLPs, master limited partnerships, have excellent yields but provide average inflation protection, and your risk with MLPs is going to be the management of the master limited partnership. Do they execute or not? Do they do a good job or a bad job? Let's take a look at a couple MLPs and how they've fared over time. Most people have heard of EPD, and you can see that since the late 90s, the share price has given great inflation protection. Let's look at the dividend. EPD dividend has also given excellent inflation protection. Plains All American Pipeline LP, on the other hand, has not done such a great job at protecting your principal. This is going back to the late 1990s. You don't see a lot of growth here. Let's take a look at the dividend. There has been some inflation protection from the dividend, but not much. And if you bought this LP 10 years ago, your income stream has come down significantly over the last 10 years. The last category on our table is my favorite, blue chip stocks. You're going to get a great yield, 3.5%. We're talking about names like US Bank, General Mills, Verizon, Coca-Cola, and others. You'll get very good inflation protection. You will have to deal with volatility, but you don't have to pay near the price that you do for the S&P 500. For investors who can commit to long-term holds, I think that blue chip stocks are an excellent cash flow generator. So let's add it all up. The road to building a $200,000 a year passive income stream has a lot of decisions along the way. How much capital do you have to invest? What type of yields are you looking for? How much inflation protection do you want? When will you need capital out of the investments, if ever? How long do you need this income stream? And what amount of volatility are you willing to accept? Lots of things to think about. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.